If you sell an investment property this year or any year after and do nothing else, the IRS can take a third of your gain in taxes, not the sale price, the gain, the appreciation you worked years to build. There's one strategy that lets you defer that legally, and it's been in the tax code since 1921. But almost every investor I've talked to gets at least one rule wrong the first time they try it. So today, I'm walking through exactly how it works and the 5 rules that determine whether it actually holds up. Quick note before we dive in, this is an educational content, not personalized tax or investment advice. Every exchange depends on your specific facts and the circumstances of the exchange. So nothing here replaces a conversation with your CPA and your attorney. I'm Johnny Lynum, investor, licensed financial advisor, retired Air Force Lieutenant Colonel, and I help real estate investors move appreciated real estate into passive tax deferred strategies. This is the exact framework I walk clients through on a daily basis in order to defer capital gains and preserve their legacy and continue to build wealth. Let's start with the basics. A 1031 exchange, named after Section 1031 of the Internal Revenue Code, lets an owner of an investment or business real estate sell a property and reinvest the proceeds into another qualifying property without immediately paying capital gains tax. Keyword there, deferred, not forgiven. The tax bill doesn't disappear. It moves down the road, and under the right circumstances, it can even be eliminated for your heirs later through estate planning. But that's a topic for a whole nother video. Here's why this matters in practical terms. So say you bought a rental property years ago for $300,000, and today is now worth $800,000. And now you owe capital gains taxes, depreciation recapture, and maybe even state taxes as well too on that $500,000 gain. That could easily be well over 100K depending on your tax bracket and state. A property that's been executed in a 1031 exchange so that now you can completely defer that 800K allows you the opportunity to defer those capital gain taxes and continue to have that money, that capital that would normally be passed over to the IRS. Now that money is still working for you and growing. And now you can defer paying those taxes. And this could be a big deal if you're looking to hold on to your next property or continue to defer gains for 10, 20, 30 years. That's 10, 20, 30 years that principle is continuing to grow and allows you to build wealth. But guess what? That sounds great, but the IRS didn't make this easy. There are 5 rules, and missing any one of them can cause the whole exchange to collapse. And so that's what we're going to talk about today, the 5 rules that you need to go through in order to have a successful 1031 exchange. Rule 1, you must use a qualified intermediary, a neutral third party who holds your sale proceeds between the sale of your old property and the purchase of your new one. This is not optional, and it's not your attorney or your real estate agent by default. You cannot touch that money at all, not for even a single day, not to just borrow it for a few weeks. You know, if those funds hit your personal bank account, even for one day, the exchange is completely disqualified and everything stops. Always tell clients you want to talk to your QI before you even sign a listing agreement, not after you've already accepted an offer. And so now really looking at rule number 2 and what that looks like, because the first rule is extremely important. You got to have the QI. But rule 2 is, you got to focus on 45 days. And so 45 days, calendar days at that, weekends and holidays do count. That there's no extension for a slow market or a holiday weekend, or you can't find anything. The IRS doesn't care. And generally, it's the tightest requirement in the whole entire 1031 process. So browsing listings and you're trying to look and find a deal, but guess what? You got to make a lot of decisions in a short amount of time on finding 3 deals that you could potentially close on in the next 180 days to execute this exchange. And I think this is extremely important why planning ahead before your property even sells, before you go into contract makes such a difference, especially because you want to be able to do as much due diligence as possible. And so a lot of times, clients are looking, they're scrambling. There's property sold, they got an all cash offer. And next thing you know, hey, I got plenty of time turns into, hey, I'm accepting this offer. We're closing on my property in 2 weeks. Got to find a replacement property in 45 days. And, you can easily be scrambling, trying to find the next deal. And guess what? If there aren't any good deals on the market, you could be stuck going into a potentially less than favorable. I won't say bad, but sometimes it can be a bad deal where you're having to overpay, because guess what? The other seller, they know a lot of times, hey, you're under the gun because you're doing a 1031 exchange. So now that takes a lot of leverage away from you, because the seller says, hey, no, I can hold out this guy. He has limited options, he or she. And can, I don't have to really have any concessions. And so it could put you really at behind the eight ball, if you will, in regards to your negotiation power, just because they know you're on the clock and you have to identify the property and get it closed in a short amount of time. So 45 days to identify your replacement property. And that's just identify. So your QI is going to send a letter to the IRS saying, hey, Johnny's doing a 1031 exchange. He's found these three properties he's interested in. And then you have 45 days to notify them of that. And once you notify them that you have kind of found a few properties you're interested in replacing and deferring those capital gains, then you move to rule number 3. And rule number 3 allows you to know that, well, not allows you, but it tells you you have 180 days from when you sold your last property to actually close on the deal. And so that's where we are. So rule 3, you have 180 days total from your original sale date to close on the replacement property. So not 180 days from when you identified it, 180 days from the original closing date. Both clocks are running simultaneously from day one. So in practice, once your 45-day identification window closes, you often have significantly less than 135 days left to actually get to the closing table. And so I think that's one of the things you have to really think about, that, hey, you're going to go through due diligence. If you find something in due diligence that you don't like and you bag out that first deal, now that's why you have 3 properties. You can move on, and hopefully the other 2 that you identified, they're not under contract to go to be sold to someone else. Because if they are, and you didn't identify either one of those properties or another property that you can close on, then you're in bad shape. You're screwed. Because guess what? You told the IRS I'm about one of these 3 properties, and there are 0 exceptions if you don't close on one of those 3 properties. And so that's one of the things that when you're going under contract, you may have 30 days of due diligence. If something doesn't work out, hopefully the other 2 properties are still around. They may or may not be. That's one of the things that I work with clients on their strategy with, looking at Delaware statutory trust as a passive backup option, just where they don't defer, but totally bust their exchange and they're not able to defer their gains. But now they have a backup property that they can allocate capital into and still keep and meet the requirements of the exchange. And so that's one of the things that you definitely want to have flexibility in your approach. And that's why it's really good to talk to professionals ahead of time where you're not caught behind the 8 ball. So now moving into rule number 4 is really focused on whether or not you're going to find equal or greater value in your property that you're buying for full deferral. So rule number 4, to defer 100% of your capital gains tax, your replacement property generally needs to be of equal or greater value than what you sold for, and you need to reinvest all your net proceeds. Trade down in value or pull cash out along the way, and you may owe taxes on that difference, something the IRS calls boot. I've talked to investors who thought they fully deferred their gain, only to discover at tax time that a portion was actually taxable because they didn't reinvest every single dollar from the transaction. And so that's extremely important, that you understand that, hey, that you have to replace the full value of what you are deferring from the gain. So if you buy a property that's a little bit less than what that gain is, then you could potentially owe taxes, and vice versa, where you may have to go in a position where you may have to add money if you buy something that's more expensive, which is okay. But you want to make sure that you're going in eyes wide open, regardless, when you're looking at the rules and understanding what your total capital gain exposure will be. That's why it's extremely important to talk with your CPA as you're going through this process. Rule number 5. And I think this is one that is really big, is really understanding that this has to be for an investment property. I know there's certain rules right now where that they just passed legislation where they're increasing what you can defer taxes on for your primary residence. I think they're taking it up now to $1 million for a couple. But right now, with the 1031 exchange, it is held to investment properties only, investment use only. So rule number 5, both the property you're selling and the property you're buying have to be held for investment or business use. Your primary residence doesn't qualify. A property you're planning to flip in 60 days doesn't qualify either. The intent has to be for investment purposes, not a quick resale. So that's one that's extremely important. So here's the big picture. A 1031 exchange isn't a loophole. It's not a guarantee. It's a planning tool, Done correctly, it lets more of your equity stay invested and working for you instead of being lost to taxes at the moment of sale. Done incorrectly or miss one deadline, lets proceeds touch your account, trade down in value without realizing it, and the whole exchange can collapse, which means you owe the exact tax bill that you were trying to defer, sometimes with added stress and legal fees on top of it. At the end of the day, that's extremely important why you have to watch the timeline. Discipline is extremely important during this process. And actually having a tax strategy itself is extremely important to really have a plan, because the last thing that you want to do is wait until you're in the field trying to figure out your objectives. And the last thing, not having a real goal or real sense of what the goal is and what success looks like. This is one of the basic military principles that, we lived and died by in the Air Force, was our planning and mission planning and planning ahead for the contingencies on what could happen. And so having a plan, having the right people on your team, the expertise that they bring to the table surrounded around you, where now you can set yourself up for long-term success. And that's at the end of the day, that it's the same thing applies here. That the best time to plan your 1031 exchange is before you even list your property, not after you've already got a buyer and the clock is already started. That's the wrong time that you want to be looking at. Put together a full guide for you that are interested that walks you through all of this in plain language, including how Delaware statutory trusts that I mentioned fit into this picture for investors who want passive income without another active property to manage. My link's down below, and you can find it in the description. Would love to have a conversation. If you're sitting on appreciated property right now and you have some gain and the clock hasn't started yet, this is exactly the right moment to have this conversation. Book a complimentary call right now. Would love to have a conversation. I usually respond to you guys in one business day to kind of get on the calendar and follow up with you if you have any comments. And I will see you on the next video. Let's go. Let's make some equity happen together.